SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi e-lecture on geopolitical rifts. What implications for the international role of the US dollar and the euro? Against the background of escalating geopolitical and geoeconomic rifts, discussions about implications for the international role of the US dollar and the euro, and of course also for US dollar assets and euro assets, have gained momentum. How real is the scenario that the US dollar's role as the dominant international currency might indeed be weakened? What are implications for the euro and other major currencies, but also for gold? How are these developments interwoven with shifts in investors' perceptions of safe haven and reserve assets? We will start with an overview of key findings from the ECB's report on the international role of the euro, which was published last week and is also linked on the SUERF event website. Let me give a warm welcome to our ECB speakers, Isabel Vansteenkiste, Director General of European International Relations, and Arnaud Mehl, advisor at the same Directorate General, and a renowned international expert on international monetary matters. After this, a panel of top international experts will discuss to what extent the current US administration's disruptive approach to geopolitics and international economic relations might affect the US dollar's international role and what the repercussions on Europe and the euro might be. We're privileged to welcome with us today Professor Jeffrey Frankel from Harvard Kennedy School and Gilles Moëc, Chief Economist of AXA Group. Without further ado, may I hand over to you, Isabel and Arnaud.
Thank you very much, Ernest, and thank you very much again for having us at SUERF to present the international role of the Euro report. Has become more or less an annual tradition. So just to recall that in the annual report on the international role of the euro, we always cover developments on the use of the euro outside the euro area on the previous year. So this year's report focuses on what happened in 2024. As a result, a big theme, of course, in this report are the consequences of geopolitical tensions. But Ernest, as you already alluded to, a lot has happened also in more recent months, and I will briefly already at least allude a bit to that and spice up the presentation by having some elements of that, although it's not in the report itself, of course. So let's start with an overview of developments in 2024. And this chart is more or less like our evergreen chart. It's every year there. It shows our usual index of euro's global role. And it's measured as a simple average of euro shares across the main indicators of global currency use. Now, which indicators these are, you can find it here in the footnote on the chart. And so it's a mix of indicators, or you can just go to the report and read up on more details. But this kind of aggregate index, what it shows is that the role of the euro remained broadly stable in 2024. You can see that both at current exchange rates, so that's the yellow line, and if you adjust for valuation effects, so at the constant exchange rate, so that's the blue line. Now, you may say that's a pretty dull chart, not much is happening there, but that's already noteworthy in its own right, in particular since Russia's full-scale invasion in 2022. And we see this as a factor that shows how important it is to uphold the rule of law, and we'll come back to that point also in the presentation further. Now, if we break down the international role of the euro and focus on its most traditional component, namely the role of the currency in the global foreign exchange reserves, we see the stability in the role of the euro also being visible there. On the left, you see the evolution over the last 25 years of the shares of the main reserve currencies, and the euro is highlighted in blue. Its share has been broadly unchanged since Russia's invasion of Ukraine in 2022. And we see also in this left-hand chart some other patterns emerging that we've already observed in previous years that basically continue. So one is that the share of the dollar continued to decline, whereas that of other currencies, so the red line, is picking up. And that pickup is mainly due to currencies from smaller jurisdictions, but generally domestically well-managed jurisdictions. Now the chart on the right zooms in on the holdings of euro area government debt securities by type of official investors, whereby we break it down across aligned, non-aligned and connector countries. And this breakdown is basically based on voting patterns at the UN General Assembly. I think this is now the most commonly established way of doing this breakdown. It has some flaws, but there's not really viable alternatives necessarily available. Now, if you look at this breakdown across official investors, we can see that overall holdings are broadly stable across these categories. Though what we do see, that yellow line, and so these are the non-aligned countries, shows a slight decline in holdings basically of euro-denominated government debt securities. But they remain close to historical highs, right? So that should also be kept in mind. Now, geopolitics, nevertheless, has been very much on the mind of reserve managers in 2024 and continued to weigh on their investment decision. So the charts in these slides are based on surveys of official reserve managers conducted last year. And on the left, we can see this is based on an OMFIF survey that geopolitics remains a key concern. So 80% of managers considered last year geopolitics as a major factor affecting their investment decisions in the next 5 to 10 years. And you can see that is up from 20% before Russia's invasion. On the right-hand side chart, it shows that almost 90% of central banks said that sanctions on Russia had, however, no impact on their approach to reserve management at this point in time. And the reason, presumably, is that sanctions against Russia have remained strictly in line with the international legal order. So again, coming back to this upholding of international rule of law, coming out as an essential element for the global appeal of the euro. Now, importantly, another survey was published 2 weeks ago, so it was released on the 26th of May this year by HSBC, and that confirms this picture. So around 85% of managers said that the weaponization of reserves, and this is how the question was asked, was consequential for the future of their reserve management, whereas only around 10% had actually changed their composition of the reserves at this point in time. So meanwhile, accumulation of gold by central banks has continued as a record pace, and that's also something we had covered in reports in the previous years. So on the left, you see that in 2024, central banks bought over 1,000 tons of gold. So that's the last blue bar you have there. So that's the double of the pace in the previous decades. And now the holdings of gold by central banks is at a historic peak. And so in the right-hand side chart, you can see with the blue line that central banks hold now almost as much gold as they did in the mid-1960s, so during the Bretton Woods era. So currently around 36,000 tons versus back then 38,000 tons. And actually they could still buy more. So the gray shaded area shows that central bank stock of gold now represents a much smaller share of global supply than at the time of Bretton Woods. So now we see less than 20% compared to almost 60% back then. Now, in this regard, a finding in the report that caught some attention for those who, for instance, read the FT, is that the share of gold in total official reserves, so that's the reserves comprising foreign exchange and gold reserves holdings, increased to 20% in 2024, surpassing that of the euro, which had a share of 16%. So this development in part reflects strong valuation effects. So to note, the price of gold, for instance, surged by about 30% in nominal terms in 2024 alone. And that, of course, mechanically increases the share of gold in total official reserves. Now, correcting for such valuations, the share of gold and the euro in total foreign reserves are, in fact, comparable, around 17%, if one uses end 2023 gold prices. So that's seen in the middle bars on the chart. And if one goes back to end 2021 gold prices, you see actually the share of the euro currently would still be ahead of the share of gold. So that you see on the 2 bars on the right. Now, you may think, such valuation effects, why does the share of the euro only increase by such a small amount? Well, of course, these valuation effects affect all currencies, so the share of all the currencies increases a little bit, whereas that of gold, of course, decreases in a much larger extent. Now, another factor that there's, of course, limits to what gold is held, basically, is, of course, the role of diversification. And so if you look at surveys, we see that hedging against inflation risks and geopolitical risks were influential factors behind this historically large purchase of gold. No, but whether the role of gold as an official reserve asset can increase much further is more unclear, right? And there's in fact several limitations, and we have listed them here on the right-hand side part of the chart. If you compare gold to major fiat currencies, first, its value is volatile, it's not remunerated, and it's costly to store. In fact, it could even be exposed to theft. And most importantly, the supply of gold is inelastic and cannot adjust easily to changes in international demand for liquidity and to the needs of an ever-expanding global economy. So incidentally, in fact, that's also what main historical lessons we could take as to why the gold standard eventually collapsed in World War I, as did the gold exchange standard in the 1930s. Now, I haven't covered foreign exchange reserves. Here we move in this slide to a second key component that makes up the international role of the euro, and that's the use of the euro in bonds and loans issued outside the euro area. And here we have a notable development in 2024, where we saw very strong issuance of international loans and bonds denominated in euro. In fact, the left-hand chart shows that this issuance increased in 2024 by over 40% compared to 2023 and reached around $900 billion. This is the highest level since the global financial crisis of 2007-2009, as you can see in the chart. Bonds accounted for around 2/3 of this issuance, whereas US firms alone issued $100 billion worth of euro-denominated bonds. So these bonds denominated in euro and issued by US firms are often referred to as reverse Yankees. Now, if you look at what has driven this increased issuance, in fact, the primary factor behind this were the cheaper financing costs. So in other words, changes in market expectations regarding policy rates on both sides of the Atlantic. And so that you see on the right-hand side chart with this the yellow line, which shows basically the risk-free spread between Europe and US basically in terms of, so different monetary policy expectations with lower rates basically expected in the euro area. And you see that there's quite a strong correlation with the issuance share of reverse Yankees basically. If you look into the report at other factors, we find that they play a much more limited role. And with this, I hand over to Arnaud to cover the second part of the presentation.
Right, so now I'm going to talk about trade, which is in fact one of the key novel findings of the report, and it's coming from a new survey of more than 100 central banks, which we did here at the ECB, also with colleagues of the IMF. And this slide essentially presents you the upshot of that survey, which offers new insights on the role of the major currencies for invoicing of global trade. If you look at the left chart on the slide, you'll see the global findings of our survey. There's the share of the euro, which is the blue line, as an invoicing currency of global goods exports. And it's quite apparent that it's quite stable since Russia's full-scale invasion, at more than 40% and on par with the dollar share. Now, this looks very stable and plain, but before we collected those data, this was not necessarily taken for granted. However, in some cases, there's evidence of a link between shifts in invoicing currency patterns and geopolitics. If you look instead at the chart on the right, you will see countries which saw the largest declines in the combined shares of the dollar and the euro since Russia's invasion. The largest declines were in Russia, Belarus, Kyrgyzstan, and Uzbekistan. The link to geopolitics is rather clear. Isabel, yeah, thank you. In parallel, there's also action going on in the payment space. Some countries continue to explore alternatives to traditional cross-border payment systems. For instance, Russia is pushing for the use of crypto in cross-border trade. BRICS leaders have discussed establishing their own cross-border settlement and depository infrastructure. And Hong Kong announced a couple of months ago plans to develop an Asian version of Euroclear. Meanwhile, China's cross-border interbank payment system, also known as CIPS, which is intended as an alternative to SWIFT, has continued to expand. The right chart on the slide shows that activity in this Chinese system has continued to grow rapidly, as measures both in terms of value, that's the yellow line, and in terms of number of transactions, which will be the blue line. More recently, new challenges have emerged with the advent of the Trump administration. President Trump's administration has taken initiatives to create a strategic Bitcoin reserves and a digital asset stockpile, while draft legislation on dollar-pegged stablecoins is being now considered by Congress. These initiatives may have implications for capital flows. The left chart shows that transactions in dollar-pegged stablecoins have a global reach. They flow from the Americas in yellow to Asia in red. But even more importantly, these initiatives could boost the role of the dollar and lead to shifts in demand for safe assets, with implications for global financial stability. For instance, the right chart on the slide shows that the largest dollar-pegged stablecoin issuers held nearly 150 billion worth of dollar treasury securities, notably treasury bills, by the end of 2024. And that's comparable to the holdings of entire countries like Saudi Arabia, Korea, Mexico, and Germany. And more recently still this year, the question has emerged as to whether further shifts might be underway in the landscape of international currencies. In particular, the tariff imposed by the US administration in April have led to highly unusual cross-asset correlations. Market observers are discussing whether this could herald more lasting shifts in global investor sentiments. The left chart on the slide shows that the dollar usually moves in lockstep with US yields, but this correlation has broken down since 2nd of April. The dollar has been falling, while US yields have been rising, which is highly unusual in a risk-off environment. That evidence is consistent with the view that investors may have started to raise questions about the role of the dollar as a haven. Higher US yield, in fact, might reflect in part higher term premium. In other words, a measure of risk which captures, among other things, uncertainties about the effect of US tariff policies and its fiscal trajectory. But the right chart shows that the weakening of the dollar against the euro went together with a decline in the measure of the convenience yield on the dollar. After the 2nd of April, there were several days during which investors demanded higher compensation for investing in a one-year US Treasury bond compared to a synthetic equivalent creating by hedging a one-year German bond into dollars. You see that in the jump in the yellow line of the chart, which is circled in red. And that thing was quite unusual, as investors typically prefer to invest directly in dollar-denominated cash bonds. However, it looks like that shifts in safe haven patterns have remained contained and temporary, at least so far. Importantly, we see in the chart here that net redemptions from global funds and euro area funds investing in the US in the 2nd of April have not been large compared to earlier inflows in the wake of President Trump's election. But the jury is still out. The publication of more comprehensive data for April, covering not just mutual funds, but also other investors, in mid-June by the US Treasuries, the so-called TIX data, will give us more insights. And it turns out that those data will be published in the next few days. Now it's time for me to conclude. So all in all, these developments could strengthen the global role of the euro if European policymakers create the necessary conditions. That includes several things, notably deeper and more complete economic monetary union, enhancing payment systems in Europe, having an international liquidity backstop, as we have with euro liquidity lines, and sound policies. But most importantly, recent events have shown that upholding the rule of law remains essential not only for maintaining, but perhaps also increasing global trust in the euro. Thanks for your attention, and we now turn the mic back to Ernest. Thank you.
Thank you, Arnaud, for this very comprehensive and very good overview of the very rich report, which I can really recommend to read to everybody. We now turn to Jeffrey Frankel.
Thanks for inviting me to this workshop forum. I'm going to start off with two graphs trying to capture recent developments, some of which were reflected in what we just heard from Isabel and Arnaud. This graph shows the effect of market uncertainty as measured by the VIX, the implicit perceived uncertainty in the US stock market, versus changes in the dollar. Well, we're not going step by step, but anyway, the period between 2021 and 2025 before Trump's so-called Liberation Day, the announcement of the so-called reciprocal tariffs, it was a positive relationship. On average, when the VIX, the measure of perceived uncertainty, went up, the dollar appreciated. That's the upward sloping blue line. Then since Liberation Day, since April 2nd, the pattern has been on average the reverse. On days when the VIX goes up, perceived uncertainty goes up, the dollar has depreciated. Now, this is just 2 months, and it's too early to say for sure, but I'm prepared to suggest that this is signaling a possible long-term inflection point. That term is overused, but watershed in the history of the dollar's role as an international currency. Next slide. So this is policy uncertainty, not the VIX, is perceived uncertainty about the market, but the U.S. economic policy uncertainty index during the last 25 years. And it's a coefficient showing us the effect of uncertainty as measured by the index on the exchange rate. So during most of this period, there was a positive relationship. The black line was above zero, and sometimes statistically significantly above zero. The two dramatic episodes were September 2008 to 2009, the global financial crisis, and May 2020 to September 2020, the COVID crisis. In both cases, there was a sharp increase in the positive correlation between perceived uncertainty and the value of the dollar. So the point of all this is that before Trump, the dollar was an ultra safe haven currency. If there was an increase in risk aversion or perceived uncertainty in the world, a so-called shift to a risk-off environment, investors pulled out of junk bonds, they pulled out of stocks, they pulled out of emerging market equities, they pulled out of most assets, and they went into dollars. And this was true even when the source of the uncertainty was developments in the United States, like the subprime mortgage crisis, which kind of kicked off the global financial crisis in 2008, which was a bit paradoxical, but it showed that the dollar was a safe haven. It's where people fled, investors fled in the event of increased uncertainty. This has turned around since the beginning of this year, and you'll see the last point here. From January to May of this year, the correlation was significantly negative. That during periods, like in particular April 2nd, when perceived policy uncertainty went up, the dollar depreciated rather than appreciated. If this pattern holds up, it suggests that this particular safe haven aspect of the dollar, which we've been accustomed to for a long time, may be gone. Next slide. Here's some references, but let's skip over that. Well, except to note that the position I took during most of this period is captured by a 1995 paper I wrote titled "The Exaggerated Death of the Dollar," that reports that the dollar is on its way out as a premier international currency were exaggerated. And there were episodes, 1995 were one of them, when a lot of commentary said that this was going to happen. But for the most part, the dollar held up in its role as international currency. Next slide. A lot has changed in the last 15 years. There's the so-called new view of Barry Eichengreen and co-authors that's argued that the literature had overemphasized the impregnability of the incumbent lead currency, and that the pound sterling had been supplanted more rapidly than people thought by the dollar, or equaled by the dollar right after World War I. And looking forward, a unipolar system is not the only possible global equilibrium. Rather, we might have a multipolar system. I like to think of it as a trade-off in the system between network externalities, which is argues that if everyone else is using the dollar, then you're going to use the dollar as well. Analogously to how if everyone else is speaking English as a common lingua franca, then you're going to more likely to do English as well. Trade-off between that and abusing exorbitant privilege, that if the US ran excessive budget deficits, excessive money creation, depreciation of the dollar, inflation, exchange rate uncertainty, all these things would tend to discourage investors from holding dollars and switch to other major currencies, which would kind of keep the dollar honest. And there's a trade-off. That network externalities points to a unipolar system. The competition for exorbitant privilege points to a multipolar system. Empirically, what Green and co-authors found, and others have found since, is that yes, there's been a slow shifting out of dollars by reserve currencies, but also by various other measures that Isabel and Arnaud just showed us, but not primarily into euros, rather into smaller currencies like the Australian dollar, the Danish kroner, so on, and especially into gold. That emerges pretty strongly. This was also clear from some graphs in the previous presentation. In this new view, we're emphasizing more the requirements of rule of law, an independent central bank, and a new interpretation of exorbitant privilege. So the traditional determinants that had been thought to be most important were the size of the home country's economy, where the U.S. had a big advantage, but equaled approximately by the euro area, and perhaps more recently the renminbi. The depth and liquidity and openness of the country's financial markets, and here the dollar has been well ahead of the renminbi and even the euro. The ability to hold its value, as I mentioned, measures of depreciation and uncertainty, and network externalities gave a lot of inertia to the system. If the dollar was used last period, the dollar is more likely to be used this period, other things equal. Well, those things still matter, but now we've added some new influences: rule of law, an independent central bank, which for the US dates from 1913, and most importantly, a new interpretation or an additional interpretation of what it means to abuse your exorbitant privilege. Now we talk a lot more about the use of sanctions, or the excessive use of sanctions, particularly US financial sanctions, such as curtailing foreign use of their reserves in times of crisis. Russia in particular, it's shifted after the first invasion of Crimea and has shifted its international reserves out of dollars into gold and into other currencies. There's a fair amount now of econometric work accumulating on the effects of alliances and sanctions on the holdings of the dollar. Next slide. It isn't always easy to find an effect. I'm not going to go through the econometrics in detail, but show some of the papers that have looked at whether countries that tend to vote with the United States in the in the UN hold more dollars. Where they have a military alliance with the UN, where there's actual sanctions, military alliance with the US. Instances where the US has imposed sanctions, what's the effect of that? As I mentioned, the one that shows up the most consistently is that countries that face a higher risk of US sanctions tend to hold more gold in their international reserves, as opposed to foreign exchange reserves per se. Next slide. So let me get to recent events. Is Trump accelerating the decline of the dollar as a premier international reserve currency? And I make an analogy with what happened in the 1960s and early 1970s. We already had the Triffin dilemma, in fact dating from 1959, that predicted as a very long-term basis that the dollar would come under question as the main international reserve currency, a foundation of the Bretton Woods system. That process was pretty slow. It was accelerated dramatically by the increased spending that the U.S. undertook in connection with the Vietnam War and domestic programs of Johnson and Nixon, and monetary accommodation to a large extent. Those accelerated the shift away from dollars, and I think helped precipitated the crisis of 1971 and 73, which broke up the Bretton Woods system. So that's the analogy. Is Trump accelerating the decline of the dollar, which may be was underway well before him? There's a view of the U.S. trade deficit that has been trending upwards in Washington the last couple of years. The first point is that the trade deficit is rooted in depreciation of the dollar, particularly the last 10 years. And that's a common diagnosis, nothing too remarkable in that. The second is that the fundamental reason for the dollar, and in turn the trade deficit, is the shortfall of national saving. The U.S. Households have always, for a long time, saved less, and government budget deficits are much larger now. And so that there's a shortfall of national saving, which causes increase in U.S. real interest rates, appreciation of the dollar, and the trade deficit, sometimes called the twin deficits. This goes back to the early 80s. The twin deficits are the U.S. budget deficit and the current account deficit. Well, so far so familiar. There's a additional argument that it's world's demand for dollars as a safe haven asset that is driving things at least as much as the saving investment imbalance. World central bank reserves have leveled off after 2014, been pretty steady for the last 10 years. So the argument has to be not so much central banks holding a safe haven asset as private investors' demand for U.S. Treasury bills and other U.S. assets as safe haven assets. Again, argument made by many reasonable people. But then this view that's trending in some parts of Washington, which I think is less supportable, goes on to say that the trade deficit is the reason for the U.S. decline in manufacturing, and that in turn is a reason why workers have been left behind, why incomes and wages have stagnated for unskilled workers without college education. And I question that. We hear about the Mar-a-Lago Accord. It's important to realize that no one actually in the Trump administration has promoted or talked about the Mar-a-Lago Accord, with the exception before he joined the administration of Stephen Moran, the chairman of the Council of Economic Advisors. So it's not a real thing, not even as real as Greenland, which it's clear that Trump has a feeling about, regardless if it ever materializes. I hope not into any action. Next slide. So my answer is yes, Trump is accelerating the decline of the international use of the dollar. Crazy tariffs, gratuitous ruptures with allies, quitting international institutions, pressuring the Fed to inflate, responding to ever-growing debt by flirting with default or with taxing foreign-held debt. And we saw the downgrading of the creditworthiness of U.S. debt by Moody's recently. And a general maximization of policy unpredictability, which shows up as an increase in the policy uncertainty measure. The cumulative effect, I'm worried, is to accomplish what not long ago would have seemed very difficult, to shake the once unshakable primacy of the dollar, taking a sledgehammer simultaneously to international use of the dollar as reserve currency, various other measures and determinants of international use of the dollar. There's a tendency, if other people are using the dollar, for you to use the dollar more. And if the dollar is used more in trade, then there's a tendency for us to be used more in finance. If it's used more in finance, more in pegging currencies, like central bank reserve holdings, are all sort of correlated because of these network externalities. Well, that has made it difficult to dethrone the dollar, but I think now it's happening as the effect of Trump administration policies is to take a sledgehammer simultaneously to all these things. And more important, I would say, than the possibility that the dollar loses its unquestioned #1 status as a currency is that the post-war system, the open multilateral rules-based system with the U.S. exercising a lot of leadership, that maybe that's on its way out as well. I think that's my last slide. Thank you.
Thank you very much, Jeffrey, for this blunt view on the key issues in this debate. Let's now give the word to Gilles Moëc. Gilles, the floor is yours.
Thanks a lot. It's I have to say it's a bit intimidating to be talking about this after Jeffrey. Very nice to see Isabel again. We go way back from old days in central banking. So hello to you. Basically, the way I'm approaching this is that it takes two to tango, right? When it comes to potentially changing the world's dominant reserve currency, you need someone on the way down and someone on the way up. You need someone who is constrained or which wants to renounce its exorbitant privilege, and basically which is less and less interested in being the world's dominant currency. And on the other side, you need another currency which is ready to take the burden. And finding those two conditions at the same time is not that easy. And it was one of the points that Christine Lagarde actually made in her speech recently about the fact that in 1931, when the US dollar, which had become the world's dominant currency, basically renounced this status, no one was in a position to take up the burden. And that's precisely the risk in which we are today. And it's interesting and encouraging to see that Europe is considering the possibility to provide this alternative. But with a key question, which for me is not always obvious, is it really in the interest of the Eurozone to become more of a reserve currency? So let's start with looking into the US, the region which is less interested, apparently, in benefiting from the exorbitant privilege. Jeffrey has showed a number of correlations, and I've come up with something which basically sends the same message, even if it's much more rudimentary. So what I've done here is to look at the 2-year spread between the US and Germany. Why? Very simply because in the models that I use all the time to try to come up with projections for the euro dollar, it's the most robust variable. The correlation is often quite nice, and as you can see here, since Liberation Day, the correlation is completely broken. So if we were to use the old correlation, given the interest rate differential between the US and the euro area, Germany, the euro should be at somewhere again around 102, 103 against the US dollar, and we are at 150. And for me, it's one of the best illustration, if you want, of the fact that there is definitely a sort of negative risk premium which is now embedded in a lot of American assets. It's a rational reaction to a situation where the White House, day in, day out, basically tells you we want a weaker dollar, and we're less and less interested in providing the conditions for remaining a reserve currency. If you go to the next slide, I always have this, it's a constant source of bewilderment for me. Why is it that there is so much aggravation in the US around this idea that the US dollar has played a role in the deindustrialization of the US, has basically hollowed out the US economy, which I think is absolutely not borne by data. I've done this very simple graph on the left-hand side, looking at manufacturing employment, which seems to be the obsession of the current administration. Basically, just like anywhere in the developed world, the share of manufactured jobs as a share of total employment has been falling since the early 1970s in a fairly irregular fashion. At a time when the dollar had very different regimes. So it's very hard to ascribe to the supposed strength of the US dollar any role in the deindustrialization. And one other thing which makes me even more quizzical about the current position in the US about all this is that over the last 15 years, actually, manufacturing employment has stabilized in the US. So we're now seeing this backlash against industrialization 15 years after we've hit the trough on manufactured jobs. It might not be the same manufacturing jobs, but today in the US, there are more people working in the car industry than 15 years ago. And reading the US press every morning, it feels like it's exactly the opposite, and we are continuing to see the deterioration. And when you look at the export performance of the US over the last 50 years, which is what you have on the right-hand side, I really love this metric, which is produced by the OECD, this export performance measure, volume of exports divided by the trade-weighted demand addressed to the country. The US has been doing perfectly fine. If you compare this with other countries here, I took Canada, I took Japan. These countries have gone through quite a visible deterioration of their export performance, which has not been the case for the US. Here, interestingly, I look at exports of goods and services. And this is another issue for me, which is really sort of blind spot in the current conversation. The US might not be doing well on exports of goods, on trade in goods. It's doing perfectly all right in trade in services, which you have on the next slide. The US is by far the world's dominant exporter of services by a massive margin. The second biggest exporter is the UK, and it's roughly 60% of the share of the US. So, why mend something which is not broken? That's my constant source of surprise when it comes to the current US policy approach, especially since the relationship with Europe is very nicely balanced if you take into account services in the mix. And if you go to the next slide. The only explanation I can give to this current obsession with deindustrialization, the loss of substance of the US economy, is quite simply that people have got old. Because if you think in terms of pop culture, which is something I do indulge in sometimes, who is in the US the spokesperson for the end of blue-collar America? It's Bruce Springsteen. And Bruce Springsteen became very famous in the late 70s, which was indeed a time of profound deindustrialization. And as you can see on the photograph, well, Bruce Springsteen has changed a little bit. More seriously, the obsession may come from the fact that it's easier to deal with a profound restructuring of your economy when the average age of the worker is in the early 30s than when the average age of the worker is in the late 40s. Very simply, the second chance that you have is higher. But apart from this sort of weird sociological explanation, pure economics, I don't think would tell you that the US needs to rethink its role as the provider of the world's dominant currency, but they want to. Okay. So let's look at the relationship between the US and Europe, which is, you can skip this one, we'll come back to it later. We can go to the next, It's a balanced relationship, really. Yes, the euro area has a massive trade surplus vis-a-vis the US, but we don't have a massive current account surplus vis-a-vis the US. I usually hate to look at this sort of stuff on a bilateral basis, but since Mr. Trump loves to look at bilateral balances, we need to look into that as well. And the reason why there is such a difference between our current account and our trade balance vis-a-vis the US is quite simply that we have now a very significant deficit on services and on income with the US. And I think we need to explore this. On the next slide, what you have here is the reason why we have this services deficit with the US. We import a lot of intellectual property services from the US, hence the sort of very balanced relationship, I would say, across the Atlantic. If I wanted to build a caricature, I would say that the average German worker spends his or her day on the factory floor in Germany, building cars that are going to be sold on the US market. And to do that, usually they use softwares which have been designed in the US, for which we pay royalties to Microsoft and other US companies. And when they come back home after a good day's work at the factory, they watch TV, American TV series on Netflix. So it's a very, very balanced relationship, actually. It's just that given this obsession on manufacturing, we don't accept this. But there's another almost more pernicious or more interesting aspect to the bilateral relationship between Europe and the US. It's about financial flows. And if you go to the next slide, and this is rather new, over the last 10 years, we moved from a situation in which European investments in the US were roughly equivalent in terms of stock, roughly equivalent to US investments in Europe. And then over the last 10 years, increasingly we've increased our footprint in the US to the point that our net position is to the tune of roughly $3 trillion right now. We've constantly increased our export of savings to the US, to the point that even when it comes to funding the US Treasury, it's European investors now who have taken the lead, as you can see on the right-hand side. It's a bit more complicated than that because some Chinese flows are still moving through, still channeled through Europe. But even if you take out the two countries which are usually used by Chinese entities to channel flows, which is Belgium and Luxembourg, you would see this massive increase in European investment into US treasuries and into US financial assets in general. And if you go to the next slide, we do this for some pretty good reasons. It's not that much that the income yield is great on the US. Actually, the income yield that we earn on our US investment tends to be lower than the income yield that Americans can earn on their European assets. But we make massive capital gains. And this is what you have on the right-hand side. When you try to understand why it is that we have this constant increase in our net position vis-a-vis the US, a lot of it comes from purely a valuation effects, the fact that the US equity market in particular has outperformed the European market quite nicely. So the question we should ask ourselves is, instead of lamenting constantly, which I read all the time, the fact that European savings go to the US instead of being invested at home, the question we should ask ourselves is why? And the reason is quite simple. We make money this way. And so far, at least, probably as a reflection of the fact that the US economy has a stronger potential growth than our economy, we make, very simply, more money by being invested in US assets than if we maintain most of our savings in Europe. That's a fact of life. And I'm sometimes a bit frustrated by what I hear from some political comments on the European side of things. There seems to be a massive belief in what I call the plumbing, the financial engineering of all this. The idea that if you manage to change the plumbing of the financial system, you will actually make it easier to convince Europeans to invest in Europe rather than the opposite. The reason why Europeans invest in the US is that so far, and it is changing, it made sense from a purely financial point of view. But precisely, we are in an interesting moment right now. We are in an interesting moment right now because the US is no longer telling us that we have a good chance of continuing to make good money on our investments over there. And I would make a very brief digression on Section 899, which is in the current version of the One Big Beautiful Budget Bill. Section 899 basically would mean that the US would slap a withholding tax on financial income generated in the US accruing to foreign residents if they come from countries which display unfair tax treatment of American entities. And that definition of unfairness is incredibly broad. The simple fact that you have a digital service tax, for instance, would suffice. At this stage, we don't know what is going to be the scope of Section 899. We don't even know what the Senate is going to make of Section 899. But the signal is absolutely negative. I think it's the first time I can think of a country which has been for decades benefiting from an exorbitant privilege, which has been able to fund its deficit at a lower cost of funding than it should otherwise, is basically telling us, I'm going to tax you for investing in my assets. It's a great message, really. Go on like this, and yes, the euro is going to keep on strengthening, and the euro has a chance as a reserve currency. But again, to my point, all this will work down the road. The capacity of the euro to appear as a proper alternative to the US dollar will emerge only if we can convince the rest of the world that we provide security, that's for sure. We provide a fairly stable regulatory and political environment. We don't necessarily provide a lot of investment opportunities. And that gets me to my final point, which should be on this. You can skip this one. Yes, we may finally be in a position where we have the right ingredients to extend the role of the euro as a reserve currency, because the other guy clearly is less interested in playing that role, but also because we could be, for once, in a situation in which we would offer to the rest of the world very interesting and profuse investment opportunities. I've not always been convinced that it was in the interest of the euro area that the euro would become more of a reserve currency, because I've always been worried by the Swiss example. Switzerland is a provider of a reserve currency, but because it's also a country which has a structural current account surplus, it offers to the rest of the world a very small amount of assets in which to invest, which ends up in a constant appreciation of the currency, which they are forced to counteract with FX intervention and or negative interest rates. Do we want to do the same in Europe? But there's a chance, and I will finish on this, that for once, Europe is ready to move out of its structural current account surplus to accept to move to a current account deficit region. And for me, what is the switch is this extraordinarily important decision in Germany to increase public spending massively over the coming decade. And we're talking about 12% of GDP over the next 10 years for infrastructure investment alone, which I think has the potential to really accelerate growth in Germany and potentially turn the country for once in a current account deficit country. So we would be in a position where the other guy is not providing lots of security, but we can also accept to play a bigger role in world financial flows, because we could sustain the demand for euros with a significant amount of assets which we would issue ourselves. It's a very rare combination, and we may have just come up to that combination. I stop here.
Thank you so much, Gilles, for this excellent presentation, which complemented very much what Jeffrey presented. So before we go into the Q&A session, let me give Isabel and Arnaud the opportunity to react to Jeffrey's and to Gilles' presentations and points.
First of all, I want to thank both Jeff and Gilles for the comments and insights, and I think it was a nice compliment to the report, and you played very much into the more recent developments, which I think next year in the report will be an interesting one again to cover what happened in 2025. I mean, just on Jeff, I think I fully agree with you, and I think there's a lot of discussion. I always call it the chicken with the golden egg, right? Like you abuse sanctions, and then you know, you've done that once, but then you forgo some advantage that you may have had otherwise in the future. On some of these newly emphasized determinants, I wonder if they're new or just very old and we had forgotten about them because we took them for granted in a way, you know, and it was never discussed because it was just there. And so we didn't really need to, you know, if you go further back in time, rule of law is again mentioned in the history books as being relevant for what drives an international currency. It just was never a discussion on the dollar of the euro because we just thought that it was there. And I guess we're somehow having to relearn or rediscover some things that, you know, we all took for granted, and hopefully that is done. On Gilles, I agree very much. You know, you've seen the speech by our president as well on the window of opportunity. I think there it's really in our hands, but it's also in Europe's advantage. But this is something that the same song the ECB has always been singing. Now it's just about getting the measures through to do that. And I think if you talk about the Swiss case, I think one thing is there that, you know, the capital markets union, where you work on the depth and the liquidity of European capital markets, of course, would get you over that Swiss problem of having only very few very liquid assets where foreign investors can run to in case there's a safe haven flow, basically. I don't know, Arnaud, if you want to comment on one or the other aspect. He says no.
Okay, very good. Are there any immediate reactions by Jeffrey or by Gilles? Jeffrey, please put on your microphone.
Just accept with what Isabel said, that what I described as new might be very old indeed, and we just took it for granted. So yes to that.
Thank you very much. I have a couple of questions myself, but I want to give precedence to the questions from the chat first. There's one question on gold. Now, you know, I think Isabel and Arnaud, you had a slide where you emphasized the limitations of gold as a reserve asset, and Paul Fisher in the chat thinks that these disadvantages may be overstated. One can get remunerated on gold reserve assets by lending gold to the large bullion banks, and supply isn't totally inelastic. Recycled supply varies with the price, so do marginal mines. And actually, reserve managers have suffered more from cyber fraud than from physical theft. And there is another comment by Edin on the role of gold with respect to limitations of gold as reserve assets versus, for instance, the euro. What role does inflation play? I think you had an interesting slide, if I remember well, in your deck on the real price of gold. So in some sense, that might be used to answer that questions. The question, yeah. Isabel, what do you think on these two questions?
Yeah, maybe I start and Arnaud, you compliment me. I mean, well, first of all, I think as long as you have central bank credibility and central bank independence, we should not be that worried about an inflation-prone world, right? So I think this starts from a kind of a premise that you're going to have high inflation and the central bank will somehow be unable or unwilling for whatever reason to deal with that. So I would say there was some concern after the pandemic on inflation, but if you look now at inflation expectations, for instance, in your area, they're very well anchored and relatively low. So I would not see this as a systemic argument to say reserve asset managers will shift into gold. Just a footnote, I mean, try to strike a balance here by saying, well, there is some upward scope still for investing in gold, right? And especially if you look compared to historical averages. But we also see that there is a natural upper kind of limit to that, right? And I think this inelastic supply at some point does come to bite. Maybe, you know, if you think about small fluctuations, yes, but if you start seeing about larger fluctuations, and I mean, this is what history exactly has told us, right? That, you know, there was this inability sometimes of supply to match with the demand, and of course that creates instability in the system. So I would still see some issues there. I'm not sure about if you have a reserve asset, whether you would then start lending it out, right, to have remuneration on it. I mean, this is a bit, for me, would be a question mark. So, I mean, I would say the main issue is the inelastic supply. The other factors that we mentioned, like volatile prices, no remuneration, storage costs, are secondary to that, but the inelastic supply is definitely what comes to bite compared to a fiat currency where you, at the end of the day, could have fully elastic supply. Arnaud, I don't know if you want to complement.
No, these are interesting points. I mean, I still maintain that supply elasticity is an important point when you consider gold as a reserve asset. I mean, Jeffrey alluded to the Vietnam War as a prelude to the Nixon shock, as one interesting historical example to think of when people think about the future of the dollar. If you think about gold as a future reserve asset, I mean, if I'm allowed to have a small historical analogy as well, I mean, I can't. I always think about William Jennings Bryan. He was a U.S. presidential candidate in 1960s. Jeffrey, correct me if I'm wrong, but I think he had his famous speech on the fact that for the U.S., at least for the U.S. economy back then, the gold standard was a cross of gold. So the U.S. economy was crucified on gold, and the reason for that was that gold supply is fundamentally inelastic. We can disagree on the fact that inelastic doesn't mean that it's fixed. It means that it does not adjust to the needs of an economy, and certainly not as fast as fiat currency, which can be credited on an electronic account within a matter of seconds. So that I think is an important consideration to bear in mind. And on the rest, no, I would agree with what Isabel said. So whether you can lend to the gold union banks, maybe need to trust them. Depends on the terms of the contract, the remuneration, how flexible that is. Is that as flexible as holding or having a deposit in fiat currency, dollar, euro, something else, or holding a bond, which can be sold, bought very easily? That's debatable. Yeah. So I think
Jeff, Gilles, do you want to come in on this gold topic?
Sure. I'm not sure I buy the motive of that you can lend gold out and earn a return on that. That property doesn't create a real return on gold the way corporate profits create a real return that manifests itself in dividends on equities. But I guess I'm maybe not quite as complacent as Isabel about the inflation situation. Yes, inflation seems under control at the moment, but we've got the U.S. Fiscal policy on a clearly unsustainable path. I mean, we've been worrying about this for some time, but its budget deficit is much higher than it was. And the prospects of our political system doing something about it are basically nil for years. So there's a possibility that at some stage we'll have to inflate that away, and other countries are not immune from that, including Japan and Europe, even though it may look far-fetched at the moment. Finally, oh yes, William Jennings Bryan in The Cross of Gold. Yes, you've got that right. Supply of gold was inelastic. There were very little in the way of gold discoveries between 1848, which was the California gold rush, and the end of the 19th century, gold discoveries in South Africa and Alaska. And during this period, the world economy was growing steadily, so there was insufficient supply of gold to back up the insufficient money supply required the gold, and that meant falling prices for farmers in the Midwest on their grain and the value of their land. And that's what William Jennings was saying, that we will not be crucified. We, the farmers especially. It was populism as of the 1890s and 1900, populism that has some things in common with today's populism, but not complete. I'll stop there.
Gilles, do you want to comment on that?
Yeah, I think it's a fascinating issue. First of all, if you want a historical precedent, there was a French finance minister in the 1930s who said the French bourgeoisie is dying of the gold standard, like a century before it was dying of syphilis, but at least a century ago it was not dying, saying long live the syphilis. So we come back in cycles around these issues. But joke aside, I very much agree with Geoffrey's point on inflation, and though I'm a card-carrying dove, don't get me wrong, but a few months ago, we were very close to an accident in the US. In the sense that we had this, we were waiting for this Supreme Court decision on whether or not Donald Trump had the capacity to fire the boss of the Fed during his term. The Supreme Court decided that he could not, but for a few weeks, there were lots of conversations in the market around the possibility that someone quite perpendicular to the current approach of the Fed could replace Powell. In these circumstances, I fully understand why some people would find an interest in gold, which is much easier to move indeed than it used to be. And it's a conversation I've had many times. I've always find it fascinating that people who distrust central banks are ready to invest in cryptos, where actually there's something which has been there for a few thousand years, which, okay, is technically a bit less interesting, but offers some measure of certainty, and that's gold. So for me, gold is a nice alternative to cryptos, basically.
Thank you for this investment advice, which of course you didn't give, I understand. I have a whole group of questions by Daniel Nodge from Giesecke and Devrient. And I think we should treat them separately, but I will read them out to you all, and they're really quite diverse. So the one is the question, what do you think about the potential century bond issued by the US, which could be swapped to T-bills and treasury bonds with foreign countries in exchange for continued US military support and for granting continued access to the US domestic market? In other words, acquiring century bonds for being part of the new Commonwealth. So that's this swap or blackmailing story. Then the second question is, what measures should be conducted to achieve a deep and liquid capital market within the Eurozone? How would the Savings and Investments Union initiative could go hand in hand with improving the market infrastructure, the payment and settlement system, potentially with wholesale CBDC and tokenization within the Eurozone? So this links also to Gilles' point of plumbing versus good investment opportunities, if I may freely associate. And the third question is then, can we expect an expansion within the Euro swap lines provided by the ECB? I mean, many attendants here may be aware of the discussion about US swap lines being cut at some point. And then Daniel has a final question. Can you also envision capital controls levied by the US at some point? This relates a little bit to the first question of the conversion of the 100-year treasury bond. So who wants to come in first on these quite diverse and complex topics?
Yeah, I'm smiling, so I guess he would prefer me to go first. No, I mean, on the question of all kind of, let's say, financial, I don't know, engineering, coupled with some coercion by the US government. I mean, first of all, I think we haven't really seen from the administration such proposals, right? So we've seen maybe people who are currently in the administration, who before they were in the administration, put forward such proposals, but we haven't really seen such proposals. I think the issue is always when you start putting an element of coercion in there, right? And you know that it's again the chicken with the golden egg story, right? You know, maybe you have the leverage to coerce today, but it doesn't make for a predictable, stable, liquid international currency in the long run, right? So I think you always come back to this kind of basic concerns that makes this very risky if you talk about international role of currencies. In terms of measures for deeper capital market in the Eurozone, I think you can find many publications, including from the ECB. We have staff from the ECB published an occasional paper where I can direct people to read. We also had last week the response of the ECB, so actually of all EU central banks, to the Commission consultation on SYU. So you can also look at that if you want to see things. Now, if we're talking about improving the plumbing of the system, that's something where the ECB is actually working on, and in particular when it comes to wholesale CBDC, for instance, there are experiments and projects ongoing. I mean, to note though that such improvements on market infrastructure are always longer term projects, right? So it takes a time, and in particular when we talk about, putting things on the blockchain, right, which is very popular these days to discuss. If you do that for infrastructures of the size that we are talking about and the volumes that is untested, and that will take still a significant amount of time before, if any, something will come out of that. But this is something that we are looking at the ECB, because indeed, I mean, we shouldn't stand still as technology moves forward. And of course, it is an important element. But I think if you look at the Capital Markets Union, there's many elements that bring that together. And I think, it's always a discussion about what are the more key ones, but there's many aspects that need to move basically to get a deeper and more liquid capital markets union in Europe. And we're also we're getting sometimes in more treacherous paths like, common debt issuance, so having some sort of common safe assets, which is sometimes difficult to move forward on in Europe, but is an important aspect. On swap lines, that's above Arnaud and myself's pay grade. We have a framework in place. They are monetary policy instruments, and I would say people can go to our website to understand the rationales and the motivations for extending the swap lines, and you can also see with which counterparts we currently have such swap lines in place. Arnaud, I don't know if you want to comment. No? He's happy.
Jeffrey, may I? Gilles?
Just two things. One on the 100-year bond. Clearly it has not really been put on the table. And when I read that proposal in Stephen Mirand's paper, my reaction was, technically, how do you want to do it? Because today, official holdings of US treasuries are a small fraction of overall holdings. So first, you would need to vacuum the entirety of short-term US securities held in the private sector. They probably have to do it via the central bank, and then swap it. But down the road, how do you take care of the flow? Because there would still need to be a measure of flow. But even from a technical point of view, I don't understand it. The second point, which I think is really problematic, and maybe one of the reasons why they are not putting it on the table, is that for the first time, the US has put a price tag on military protection. Now that there is, or if there was a proper price tag, then we can engage finally in a very rational internal conversation in Europe as to, if we find that the price is too high, we could do something else. For instance, develop our own sovereign defense capability. I'm a big Atlanticist personally, but the minute there's a price, there's a rational conversation. And it's incredibly risky, I think, from the US point of view, to engage in this sort of things. On plumbing, financial engineering versus investment. One of the two sub-issues for me in that, let's try to find solutions which respond to an actual problem. If I take the example of securitization, one of the reasons securitization is so developed in the US is because there was a proper objective to it, which was the creation of a deep and liquid market for 30-year fixed-term mortgages for people. So there was a political, social goal, which ended up in being a financial engineering solution. If you do the opposite, very often it doesn't work. And sometimes the conversations we have today in Europe, we tend to take things in the wrong way, thinking that the plumbing instead of thinking of what we should do with the money that we are supposed to collect. I stop here.
Thank you, Gilles. Jeffrey, do you want to comment on any of these topics?
Yeah, briefly on the question of whether the U.S. might require central banks or other investors to give up their treasury bills and accept instead century bonds, which, as I understand it, wouldn't even pay interest during the course of the century, wouldn't pay anything until 100 years off. It would basically be confiscation, it would be default. Like some of the other proposals, I think is anathema, I think won't happen, given how many things Trump has done, that has said and done that we would have thought is impossible. I guess we have to take it somewhat seriously. My best guess is if they did start more officially talking about it, that it would be reflected right away in the Treasury security market. Prices of Treasury bills would go down, Treasury bonds would go down, and that would provide a simple enough, obvious enough cause and effect problem that I would think that the Trump administration at that point would back off. Whether there's some other form of capital controls that happens less obviously via taxation is perhaps more worrisome question.
Thank you. We have another question in the chat, which I might embed in a bigger topic that was alluded to by some of you. Now, the chat question is: do you think a stronger euro stemming from its increased international role is sound amid growth concerns in Europe, despite optimism around German fiscal expansion? Now, I think this can be embedded in the broader question mentioned by some of you. Is it desirable to have an international currency, to have this exorbitant privilege? On balance, Gilles mentioned the Swiss franc and questioned or raised the question that there might also be counter-argument to wanting to have the euro becoming an international currency. And you know, when I heard the various measures on I think Jeffrey's slides, which de facto implied or could be interpreted as the US administration wanting to reduce the international role of the US dollar. So is there a change in the thinking in the US? Does the US administration implicitly want to reduce the exorbitant privilege, or does it happen by accident? So what's the policy behind? Is there a policy? Is there a strategy behind it? And on the other hand, one might hear from Isabel or from Arnaud, is there unanimity or a consensus among, let's say, European countries and central banks that it is really desirable to increase the euro's international role with all the obligations and constraints that it might also imply?
Should I start?
Yes, please.
So there's an obvious tension between the possible goal of reducing the role of the dollar as an international currency and the foreign exchange value of the dollar. Now, it's not beyond the Trump administration officials to push contradictory or conflicting goals. Trump keeps saying we want to eliminate the U.S. trade deficit even on a bilateral basis, but also says we want to increase foreign investment in the U.S. And as a matter of balance of payments accounting, that doesn't quite work. In the case of the pairing of the value of the dollar and its use as international currency, I wouldn't be quite so critical of them. They are distinct phenomena, even though they're related. You had in the early 90s the dollar depreciating, that gave rise to a lot of talk about a declining international role of the dollar, but in fact, it was a period when the international role of the dollar was not declining; it was actually increasing. They don't have to. They don't have to go together. I think if to the extent that Trump has been asked, he's had to think about it, which I don't know that he has, but I think he's in favor of lower value of the dollar, particularly against the Chinese renminbi and other countries that we are in trade competition with. But I think he is in favor of continuing the strong role of the strong dollar. Someone who gives a military parade for himself wants his currency to be strong. It's just part of the same way of thinking. And he might. That's why I said that if the U.S. pursues policy actions that undermine the international role of the dollar, it would be inadvertent. I don't think it would be an explicit goal of the current administration. Oh, one more thing. It is worth recalling that the pros and cons of having your currency as an international currency. In the past, it's not always been viewed as a net positive. The industrial sector, in particular, was very dubious about this when it was discussed in terms of the Deutschmark in the 1980s and the yen in the 1980s, which was one of the first times there was a lot of talk about the declining role of the dollar. And there were political factors in both countries that were very dubious about this because they didn't want there to be an increase in international demand for the currency and the loss in competitiveness. And finally, as an example, if you go back to 100 years or more, actually, to the origins of the U.S. as an international currency, it was not something that was favored by U.S. businessmen overall, let alone the public. It was kind of a very small clique, same people who led to the formation of the Federal Reserve, who were promoting the international role of the dollar, but they came from the financial sector, and the broad sweep of the American public and even American business was not necessarily in favor originally of the internationalization of the dollar.
Absolutely. I also still recall the Bundesbank papers on the, being very skeptical. Yeah, Isabel, what's your take on that? So the ECB seems to have a quite clear view, but what's your assessment of thinking across countries?
So maybe starting with the European view more at large. I mean, we have this open strategic autonomy agenda, and supporting the international role of the euro actually falls under that. So it's not just something that the ECB is saying. Actually, it's even European policymakers have been saying that already for some time. So this is not something that suddenly came up this year. It's just that I think because there's so much being said on international role of currencies, now all of a sudden that people are pointing their attention to that. I mean, whether it's advantages or disadvantages, I mean, and Jeff was talking about some of the concerns that some voice, right? And I mean, I think in particular in crisis time, you will see the currency appreciate because, money will flow, safe haven flows will come into your country, you'll see the currency appreciate, but it gives you also other advantages like, lower borrowing costs. And in particular in crisis times, then also gives you more fiscal space, right? Because if maybe in other countries money flows out of the country, borrowing costs go up, okay, they have a lower currency, the currency depreciates, but fiscally they have less space and their businesses are facing higher borrowing costs, ceteris paribus. So I think we need to see this overall in kind of a general equilibrium way of balancing out these exorbitant privileges and maybe some of the higher costs that come along with that. I think if you look at least even at US administration, whatever they're saying, they have never said that they want the dollar to lose an international status, right? I think this is something, maybe the policies they pursue are not consistent necessarily if you look at a textbook with maintaining the international role of the currency, but they have definitely not pursued them with that aim. And I think, generally international role of currency gives you a lot of advantages. And in particular in normal times, as Jeff was saying, it's not necessarily clear that, it goes together with an ever appreciation of your currency, right? I mean, you can also have times where you depreciate. I mean, generally, if you look at invoicing from a business perspective, right? If you have an international currency, you're going to be able to much more price in your own currency. So that normally lowers transaction costs for exporters, for instance. So there are a whole set of benefits that, maybe businesses don't perceive as directly as they perceive then this appreciation of the currency when it does occur. But I would say if you take the package together, there are advantages. And I think Gilles' point is relevant on Switzerland, but that then comes to, making sure that your capital markets are liquid and deep enough to be able to absorb the flows that you get into your jurisdiction. And of course, for smaller jurisdictions, that is more of a challenge than for bigger jurisdictions.
Gilles, you originally
Sorry,
come from France.
Sorry, can I come in?
Of course, sure.
I just have three very short things. So on the, you know, the complaints from exporters, no? So this is a long-standing thing, and Jeffrey alluded to that. So maybe a stronger currency can hit some exporters, but not all. Those whose products are not too price sensitive won't be hit as much. But it also results in lower interest rate, which benefits the silent majority in the economy. So you have this trade-off, no, that you need to think about when you have an international currency. That's the first thing. Second, in terms of benefits and costs, I can speak for a central bank. And for a central bank, an international currency makes your monetary policy more autonomous. It's a shield against external disturbances. That's what Isabel was talking about. When a stronger share of your trade is invoiced in euro, you have less pass-through. And third, it makes monetary policy transmission stronger. So there are clear benefits. And the third thing, in terms of whether, you know, there is consensus in Europe for a strong international role of the euro, all I can say, on my own reading, there is a lot of consensus on the policies that make the role of the euro stronger. You know, capital markets union, sound policies, rule of law. The cookbook is here and ready and repeated report after report. The key question is, you know, how to do that. That's the overarching question. Sorry.
Thank you. Gilles, you want to come in on this question?
Yeah, I mean, I agree with Arnaud that down the road it's a distributional problem. But basically, and to take again the Swiss example, what Switzerland has done is that its industry tends to be insensitive to exchange rates because of its specialization. If you do lots of pharma, you can probably deal with an almost constantly appreciating currency. If you produce steel, it's much more complicated. So the distributional effects, I think, are quite consistent. But down the road, but that's because I'm French and I don't really care about current account surpluses. One way to deal with sort of on-trend appreciating currency is to strengthen your domestic demand, which is something we haven't done in Europe for the last 15 years, basically after the sovereign crisis of 2010, 2011. And as far as I'm concerned, the fact that there is now this idea that domestic demand may to some extent replace external demand in Germany is a very, very welcome move.
Thank you very much, Gilles. I think we've run out of time. So let me conclude this SUERF-BAFFI Bocconi e-lecture on geopolitical rifts, what implications for the international role of the US dollar and the euro. A great thank you to our speakers, Isabel, Arnaud, Jeffrey, and Gilles, for your excellent presentations and the open discussion, and to all of you for your questions, comments, interest, and for your participation. Bye-bye and take care.
Bye-bye.
Bye. Thank you.